Welcome, friends. So we are looking at audit reporting. Okay, so at the end of the day, after we've done all our audit work, what next? We've got to report, okay, to those who have mandated us or who have engaged us to undertake this assignment. So audit reporting is quite important. Let's go straight into it. So before I move on to audit reporting, I would want you to take a look at just one sentence. Yes. So I want you to look at chapter 26, the auditor's report to shareholders. And then actually chapter 27, auditor's report to directors, has been treated earlier, okay? It's so interesting how we try to bring them or to match them up. Okay, so let's look at auditor's report to shareholders. I share my screen. Just 1 second. Yes. All right. Okay, so good. I'll not bother you so much with the ISAs, okay? This is not advanced audit, but I will quickly touch on them as we run through, okay? We'll quickly touch on them as we run through. Let's look at the learning objectives. So we want to explain the content of the auditor's report. We will not go too deep into it. Once again, this is not advanced audit. Remember the Royal Bank of Scotland case and the auditor's liability versus Bannerman, where the issue of proximity comes in. Okay, and we try to say that if someone will rely on your work, you have a duty of care to ensure that whatever content you report will not mislead that person. So the person will actually rely on your report. For that matter, today we have the Bannerman wording, where auditors will always want to put in a whole paragraph trying to disclaim that, listen, this report is only directed at the company and those who matter around them or those who have mandated us. So if you are an external party, we don't know you, we don't have any proximity with you, we don't know whether you're going to rely on this report, and you rely on this report and it misleads you, that's your headache. So we have this Bannerman report, and ACCA has said that if we have to plug in this Bannerman report, if care is not taken, auditors will end up doing shoddy job because they know that there is always some form of insurance clause which is indemnifying them or which is protecting them from any future liabilities. Okay, so we will look at that. Again, we'll look at what is meant by a modified report. Every company would like to have an unmodified or unqualified report. In effect, they want to have a clean report. Okay, but if we want to modify the report, modified reports are not good. Okay, they are not the best. Everybody wants an unmodified, unqualified, a clean sheet. Okay, how are these modified reports worded? We wouldn't spend so much time on those elements. What I would really want you friends to do is to go to chapter 26, okay? Chapter 26, and then you will find examples of the auditor's report to the shareholders. I've plugged in some appendices in the slides, but I really want you to spend so much time and look at the examples in the text, in the core text, okay? If you take the ACCA text, you see samples of these items there, okay? So we're not going to be delving deep into this for now. It's not an advanced audit, but we'll look at it. We'll touch them, okay? We'll also look at the possible effects of a modified report on the entity. Read that one. Personal assignment, read that one. We'll briefly touch on the purpose of an emphasis of matter report, and then we explain the consequences of issuing an audit report knowing it is false. You read that one as well. Okay, so possible effects of an unmodified report on the entity, and then the last objective, consequences of issuing an audit report knowing it is false. You read that one. All right. So reporting lines, in terms of audit reporting procedures, who do report to? We are the auditors. We must always distinguish between external responsibilities, which has been placed on us as auditors, then our external audit responsibilities, clearly. But principally as an auditor, what you know is that your audit reports is being addressed toward a particular group of people, okay? So you are addressing to some particular group of people, providing an assurance, reasonable assurance, of course, of the report that you have issued, of the work that you've done. You must ideally also communicate the nature of any problems you've identified, if possible, explain the cause of that problem, and also bring out any criteria that it has violated, any standard procedures, any regulations, any laws that it has violated, clearly state it. Then also explain to these addressees the potential effects or the actual effects of these problems on the company, on the operations. And then tell management that, listen, you don't leave this thing hanging. You must act on it. You must fix it. And possibly it is required that you must also provide some feasible and practical ways to correct these actions, okay? So that is one thing we should know, very important. You find this normally in the management letters, the reports to the directors, but of course to the shareholders of also, you have to share these management letters to them. Now, as external auditors, we're always seen as independent, okay? We carry out our works in line with laid down regulations and procedures, but per the Companies Act 2006 in the UK, audit reports are to the shareholders of the company, because they appoint you, they remove you at their AGM. So your primary responsibility to the shareholders. Still remember the agency theory. And of course, if you may have come across the stewardship theory, the same thing is being propounded here. Make sure you safeguard or you work for the interest of the principals to ensure that the agents do not run the company to their own personal whims and caprices at the expense of the principals. That's why audit becomes very necessary. Remember the initial topic on why auditing. Okay, it comes in here. For public sector reports, there could be statutory reporting responsibilities, and these are usually defined by relevant statutes or legal mandates. Okay, constitutional instruments or legislative instruments will require that if you want to audit BBC, it's a public entity, public sector items. We want you to report it in a certain way. Okay, external auditors will also carry out assurance assignments, not necessarily audits. Okay. And again, these would normally be defined by statutes or mandates, and they will normally receive separate written instructions on what to do, how to do it. It could be a due diligence procedure. It could be an agreed upon procedure. All right. Now, ISA 700 forming an opinion on an audit. Okay, you'll find the Companies Act relevant statutes are all clearly stated there. And it tells you that the auditor's report and financial statement should contain a clearly written expression of opinion on the financial statements, taken as a whole, and it should be based on the auditor evaluating the conclusions he has drawn from the audit evidence he's obtained. So before we end up drawing a conclusion, there is a basis for which we are drawing that conclusion. That basis which is leading us to draw this conclusion or to express this opinion would normally be supported by some form of concrete facts and findings. Fact findings, okay, not fiction, not on feelings, okay. Some substantive elements, audit evidence, appropriate and sufficient enough to support our conclusions, okay. And we must do this from our dimensions as independent as possible. So that's why I said, as an auditor, we must ensure we've gathered some sufficient, appropriate audit evidence to support the opinion we are expressing. Remember, this is what? A reasonable assurance. It's not an absolute assurance. So what we are saying is not a foolproof. We are saying that to a very great extent, based on the work we've done, we think that the financial statements are free from material errors and misstatements. Reasonably, not absolutely, okay? There are also, the auditors also have to consider whether the contents of the financial statements are been presented fairly in line with all relevant statutes, Companies Code 206, UK Corporate Governance Code 2018, the relevant ISAs. If there's an IFRS, you are preparing the financials in line with, clearly presented in line with these statutes and regulations and standards. Again, consider any uncorrected errors if they are material or not, okay? We will look at these uncorrected errors in the subsequent events, in the final reviews, okay, in the final reviews. But we'll still touch on it again. Like I said, anything we look at, so you still find these uncorrected errors in the same unit that we are looking at, this final unit. Now, you will see that, like I said, audit is cyclical. You say something today, you go a very long way, and you go and meet that same sentence, and you say it again. So we get used to the terminologies, okay? So if there have been any uncorrected errors, are they material? Okay, and how do we deal with them? All right. Key considerations we need to look out for as auditors. The financial statements we have validated or we express an opinion on. We should be sure that these financial statements adequately refer to and describe the relevant financial reporting frameworks. So if it is a US GAAP, a UK GAAP, a Ghanaian GAAP, okay, Nigerian GAAP, IFRS, okay, have these been clearly described? And not only being described in line with the FR framework, financial reporting framework, we should also disclose the extent to which significant accounting policies have been selected and applied in preparing these financial reports. Now, these accounting policies, which have been selected and applied, are they consistently applied within the FR framework, within the reporting framework? Are they relevant? Are they appropriate? Are they reasonable? Okay, if there's been any estimates which has been used or we have adopted in the financial statements, are these estimates reasonable? Normally, they will be based on management judgments, they will have basis upon which they are making these estimates. Are they reasonable? The information presented in the financial statement, can we rely on them? Are they relevant to the dispensation within which the company is operating, or the company's environment, the nature of work that they do? The information in the financial statement, can we compare them to previous years, to a competitor within the industry? Can we understand the information which has been presented? So as an auditor, it is always important to take one step back and put yourself in the shoes of the user of the report and ask yourself, if I'm a layman, I didn't get myself involved in this audit, will I understand this? Okay. The financial statements should provide adequate disclosure so that any person who is using this report can better understand it. To the extent that if there has been any item of material transaction that can affect my judgment as a user, I'll take note of it. So once again, auditors, like an examiner, like a teacher, I, for example, lecture, whenever I set questions for my students, I sit back and put myself in the shoes of the student and take a plain sheet and a paper and decide to answer the questions very slowly, take my time, and see whether I can finish this question within the allocated time frame. If personally I'm not able to finish the exams within that 2 hours or 3 hours, I don't think I should give this to a student whom I should expect to use 2-3 hours to answer. Okay, so the same thing applies here as an auditor. Whatever you are doing, put yourself in the shoes of a user and ask yourself, have there been sufficient disclosures to help that user make an informed decision? Can the user understand it? Okay. Now, any terminologies we've used in the financial statements should be appropriate. Should be appropriate. Okay, so don't mislead the user of the financial statement with some terminologies which may be confusing or which somebody will not be able to understand. Financial Reporting Standard 18 talks of accounting policies, disclosures, okay, relevant practices which have been applied. In your final review of the financial statements, match it to the IFRS 18. Okay, and as part of looking at accounting policies, reviewing these accounting policies, check for compliance. Check for full disclosures in the accounts. and check that this has been consistently applied over time. Today, we don't start with X policy or X standard, only to use Y standard to treat the same class of transactions. No. Okay, so in applying FRS 18 on financial accounting policies, make sure you check for compliance, disclosures, and consistency over time. It is also important as part of our final review, before we even express opinion, to perform final analytical procedures, to check the relationships between financial and non-financial, financial and financial, and to be able to seek any deviations. If there's been any material deviations, we seek explanations into these deviations, right? We should finalize our audit. So I said, as part of the finalization, reviewing the final review process, ISA 450 says, let's consider any misstatements identified during the audit, material misstatements. So any uncorrected errors, ask yourself, is it as a result of a mistake that they genuinely committed? If it is fraudulent, that is a different case. You have to consider the materiality of the fraud and then ask whether I should continue to express a clean opinion or put an exception on it or disclaim the opinion. Again, any mistakes could be judgmental. Management will make an estimate, an accounting estimate, and perhaps they didn't do it well. It was inappropriately estimated. Sometimes mistakes could also come from projected items. So you make a mistake because the sampling error that you took, you would have projected that error not using the sufficient parameters. Simply what I'm saying is mistakes could be projected into the population from sample testing. If you select inappropriate samples and you use that one to draw a conclusion, and you use that same conclusion to project or maybe to undertake a substantive procedure or an analytical procedure, that could also be wrong. Okay, so be careful the sampling procedure that you use. It could give us some errors. Again, identify all uncorrected misstatements during the audit. There could be adjustment you ask management to pass. They may not want to pass. There could be some disagreements, or for whatever reason, these mistakes will not be corrected. Check the nature of these uncorrected misstatements. Ask yourself, do we have sufficient audit procedures that we can undertake in light of these mistakes? Can we conduct further procedures to see whether these mistakes needs to be left uncorrected or still at all costs it must be corrected? And what if management decides not to correct it? What happens to our situation? If the uncorrected materiality exceeds our uncorrected misstatements, if the uncorrected misstatements exceed our materiality, then of course, we have all grounds to not give them an unqualified opinion. We can modify the report. If management will not change these uncorrected misstatements, we need them to explain to us why they think they don't want to explain, they don't want to correct it. We don't just accept oral explanation. They should put it in their management representation letters. You will find this in the management representation letters. Now, we as auditors must write to the directors requesting them that these material misstatements must be adjusted. If they don't, you can take a stand. Okay. Look at the next slide or the video on final reviews, and you get more information on these uncorrected errors. There are key audit matters. Once again, I will hang on that, not deeply. So like the name sounds, a key audit matter, I would want you to take a look at it. If you look at page 413 of the core text, you will see an independent auditor's report, a sample, an example placed there, okay? And when you move towards the end, you will see a key audit matter clearly cited over there, okay? So usually key audit matters are those matters that in the judgment of the auditors are of significance to the audit. So you must always consider those things. But listen, it normally applies to listed companies, PIEs, unlisted PIEs, or any other entity which are required, and those which choose to report on how they want to comply with the corporate governance code. So not to all entities, okay? This does not apply where the auditor wants to disclaim an opinion. Disclaim an opinion, like we've discussed, it simply means I don't want to express an opinion on this one. I disclaim my opinion. I just will not express on the financial statement. So if the auditor is actually disclaiming his opinion, no need to even report on this one. No need to report on this. Again, we want to also consider, still under key audit matters, I want you to consider ISA 701, okay, where we communicate key audit matters in the independent auditor's report. Here it says that we must include reference to materiality, not just the performance materiality, but the overall materiality as well. So any communication of key audit matters in line with ISA 701 in the auditor's report should have reference to materiality and performance materiality. And they must, of course, explain to whoever is using this report why it is important and how it differs from performance materiality, why the materiality, the bigger picture is different from the smaller picture, the transaction level from the account balances level. In particular, they must show for each category how they've estimated materiality and performance materiality for the financial statements and provide an explanation of any significant judgments which the auditor made in estimating this materiality. There's always a benchmark, or should I say a formula for assessing this materiality, and then the transaction level performance materiality. So all this will have to be disclosed in the financial report. At a minimum, the content of any auditor's report must have the title. Okay. Once again, I will say go to the chapter 26, and then you have a very good example of auditor's reports in that section. I've also populated some examples there, some appendices there. We will look at them. Okay, but I want to give you a very clear example. Look for, regardless of the type of audit report, look from page 421. There's an example A there, through to page 424. You see examples of auditors' reports over there, examples there. Okay, so I'll leave that one for you. At a minimum, it should have a title, those to whom the report is being addressed, what has been audited, and how did we audit it, in line with which reporting framework. There's always the opinion paragraph, and then there is a basis for the opinion which has been drawn. Any conclusions which has been made in line with going concern must be clearly stated. Opinions on other matters required by the Companies Act, such as content of director's report, director's remuneration, anything must be clearly stated in line with the CA 206. Matters on which auditors are required to report by exception. For example, we have nothing to report on the ESGs or on the CSR, something of that nature. Statement of directors and auditors' responsibilities must be clearly stated within the report, so you know who does what is requested of whom. It helps to breach or close that expectation gap, which we have known in this module. Once again, that it must be dated, auditor's signature, and then the address will be there. If it's most audit firms will not be an individual name. So if it is Grant Thornton, you find Grant Thornton signed. Okay, if it is KPMG, you find KPMG signed. So the disclaimer caveats in the Royal Bank of Scotland and Bannerman case. So this is a standardized wording, okay, a standardized wording which most companies will just adopt. And it says, so it's a disclaimer statement. So this report is made solely to the company's members as a body in accordance with Chapter 3 of Part 16 of the Companies Act 206. Our audit has been undertaken so that we might state to the company's members those matters we are required to state to them in an auditor's report and for no other purpose. To the fullest extent permitted by law, we do not accept or assume responsibility to anyone other than the company and the company's members as a body for our audit work, for these reports and for the opinions we have formed. they try to just shield themselves. An indemnity clause. Shield yourself, okay? That's the nature of the work. Always get an insurance policy to safeguard yourself from risks, okay? Those risks you can tolerate them. Those risks you can avoid, totally avoid them. Those you can transfer. Okay, those you can accept. ISA 7, so I'm just going to pick quick ones and see on what basis do we modify or qualify audit opinion. Okay, there are two bases. Is the situation material and pervasive? Or is it material but not pervasive? If it is pervasive, said that it's so significant in terms of understanding of the accounts that should cause the auditor to either not express opinion or refuse to express opinion. So it could be adverse or disclaimer. Adverse means we think it does not present a free and fair view. Adverse, a negative. It does not represent a true and fair view. Disclaimer, I don't express an opinion on these accounts, okay? But if it is material but not pervasive, then we always have an exception, except for, okay, limited options. Okay, let's look at examples. So if there's a scope limitation, the management prevented me from doing the work the way I'm supposed to do it. Said that I couldn't audit the PPE very well or the current assets very well. They've limited me. Now, if it so happens that this limitation of scope is material and pervasive, it cuts across, then I disclaim my opinion. I just disclaim an opinion, okay? So I'll say, because of X, Y, Z, we do not express. When we say disclaim, we don't express. I do not express an opinion on the financial statements. That's it, we are done. But if the limitation of scope is material but not pervasive, maybe this table, you can just add material and pervasive. Instead of just having pervasive there, but inherently there's material there, okay? But if it is material but not pervasive, you can just say except for the matters shown in PPE, the financial statements give a true and fair view, okay? If there's been disagreement between the auditors and the management on certain key items, if accounts have been materially misstated, and it is to the extent that it is materially stated and pervasive, the disagreement is quite pervasive and material between the auditors and the clients. Adverse opinion. The financials do not express a true and fair view, do not give a true and fair view, that's it. But if it is material but not pervasive, you plug in an except for the matter shown in XYZ, the financial material statements, the financial statements or give a true and fair view, okay? All right. I think, yes, the financial statement. When you look at the slides or the lecture material, it will say the material statements give a true and fair view, but I think it should be the financial statements. I don't know why the publishers use material statement, but it should be the financial statements, okay? In the real slides, you will see that I've changed it, but in the video, I kept it as in line with the text, but I think that it's a little hitch. It should have been the financial statements give a true and fair view. The financial statement give a true and fair view. I don't know what is material statements. Then we have emphasis of matter, not much to be spent here. So where there are uncertainties, okay, which may be outside the control of the organization, like a legal tussle, an unknown future event, we need to emphasize that in the statement, in the report, okay? So auditors must disclose this emphasis of matter in their report without any qualification. You emphasize a particular key without any qualification, okay? I want to see a typical example of an emphasis of matter, a clear example of an emphasis of matter. I'll show you one item as well. Okay, I'll show you one item as well. So, but if you take the text, the core text comes there, except for an emphasis of matter. You should find them in the examples that I stated, okay? So you'll find examples on qualified basis for qualification, matters for which we are required to report by exceptions, okay? Matters on which we are required to report on exceptions, okay? So you always find emphasis of matter. So at this point, with emphasis of matter paragraph in the report, we must always draw attention to that matter suitably reported in the financial statement. It's not a modification. You are not qualifying the account, but you're emphasizing a particular key item over there. If these matters are not properly disclosed, then we can qualify the accounts. But if the client will agree for us to clearly disclose it, then no need for qualification. So these are examples. These are appendices I plugged in there. You find all of this in the core text. Okay, you find all of this in the core text. So I wouldn't want to worry so much on this. Okay, so an example of the emphasis of matter, for let's say a possible outcome of a lawsuit, you normally find is that informing our opinion in the financial statement, which is not qualified, okay, unqualified, it's a good one, it's a good report. We have considered the adequacy of the disclosures made in note, let's say note 3, to the financial statements concerning the possible outcome of a lawsuit, alleging infringement of certain patent rights and claiming royalties and punitive damages, where the company is the defendant. The company has filed a counter action, and preliminary hearings and discovery proceedings on both actions are in progress. The ultimate outcome of the matter cannot presently be determined, and no provision for any liability that may result has been made in the financial statement. So there's a lawsuit. It's in court. We don't know the future outcome, but we emphasize that. You find this example in page 427 of the core text. Okay, so these appendices, I'll leave them for you. Look at sample wording of the content of the auditor's report. Okay, you don't have to worry yourself so much on this, because in the workplace you normally find them. These are done by the senior guys at the top. Content of an auditor's report. So you find a Bannerman wording there. You see key audit matters stated that the opinion is there, the basis for the opinion. Who uses our report? That's the caveat, the disclaimer you plug in there, okay? And then other information we want to highlight, opinions on other matters prescribed by the Companies Act, and then matters on which we are required to report by exceptions. What are the responsibilities of directors? What are responsibilities of the auditors? You state all of this, okay? And then communication with those charged with governance, you always have to plug this one in. And then material uncertainty relating to going concern. We're looking at we look at going concern. We look at going concern in a different one, in a different item altogether. So I wouldn't worry my head here. On subsequent events, we look at going concern in subsequent events, which is a different topic you would see in the same unit. Okay. Once again, examples of key audit matters and modified audit reports, 2 scenarios given, please address them and check. Finally, you could always modify your audit reports if the issues, like I said, if financial statements are materially misstated and they are material and pervasive, adverse opinion, adverse, okay? They do not, the financial statement do not give a true and fair view. But if they are material but not pervasive, except for the items in ABC, the financial statement represents a true and fair view. If we are unable to obtain sufficient appropriate audit evidence, scope limitations, disclaim your opinion. I do not express opinion on this. I did not. Okay, disclaim the opinion. Okay, I refuse to express an opinion. But if it is not pervasive, that is it. All right, I end here, friends. There's a question, case study once again. Please try them, page 428 on harm and jam. And then the self-testing question should be your guide when you're studying this topic. At will, attempt any examination questions on page 429 to 413. I said especially the ACCA question on page 430 pertaining to Galathaco and Jonak and co. All right, friends, I end here. I'll see you when I see you. Yeah. All right. So this went deep. I thought I would finish this in 20 minutes, but it went past 30 minutes. No worries. Take it easy. I'll see you when I see you. Bye for now.